Hello students, welcome to the brief explanation of the topics that are going to be covered during week 4. During day 1, I would be solving problems on final accounts of company, and also in day 2 I'll be solving case study problems on final accounts of company accounts. During day 3, I will be starting with module 3, that is financial statement analysis. There I will be discussing about the introduction to financial statements, meaning of financial statement, features of financial statements, objectives, nature, essentials, importance and limitations of financial statements. And also I would be discussing about purpose of financial statement analysis, and I would be discussing about trend analysis. So coming to the introduction to financial statements, analyzing financial statements is a process of evaluating the relationship between the component parts of a financial statement in order to obtain better understanding of firm's position and performance. The primary objectives of financial reporting are to provide information to present and potential investors, creditors, and other people in making decisions. Effective decision making requires evaluation of the past performance of companies and assessment of their future prospects. So, before understanding the importance of financial statement analysis and its tools for analysis, it is the time to understand about financial statements, its objectives and features. The ultimate objective or result of financial accounting is communicating the true and fair financial position to the required people in the prescribed manner, which includes preparation of income statements and balance sheet. It is intended to convey the profitability position and the overall financial soundness of the concern, but sometimes only the financial statements like income statement and balance sheet in its actual form cannot convey the true and fair financial position. It needs to be analyzed as per the requirement of the circumstances and objectives of the needy people, and it needs the different ways of presentation for different people so that the same facts and figures can serve different objectives. So, in this regard, it is essential to understand the concept of financial statement analysis. Financial statements, they are the essential documents of business and they are the outputs of financial accounting. They are the final products of the accounting process which contain financial information of the business enterprise. They convey certain message to feel financial pearls of an organization, and the basic purpose of preparing financial statements is to convey information about financial position of the enterprise to owners, creditors and the investors. Financial statements are the basic and formal annual reports through which the corporate management communicates financial information to its owners and various other external parties, which include investors, tax authorities, government, employees, public, etc. And this normally refer to the balance sheet as at the end of the accounting period and the statement of profit and loss of a company. Coming to the features of financial statements, actually these financial statements are the recorded facts and they make use of the accounting concepts and conventions in preparing financial statements, and they are prepared on certain basic assumptions which are called as postulates, like going concern postulate, money measurement, realization, etc. And under more than one circumstance, facts and figures presented through financial statements, they are based on personal opinion, estimates and judgments. That is, financial statements, preparation of financial statements has the personal opinion, judgment and estimation of using a particular uh, convention, like for example for the valuation of inventory or for the calculation of depreciation, whether to use straight line method or the written down value method. Why financial statements are important? It is important to provide information about economic resources and also the obligations of the business enterprise, to provide information about the earning capacity, to provide information about the cash flows and to judge the effectiveness of the management, and also to provide information about the activities of business affecting the society, and also for disclosing the accounting policies. And financial statements nature, they possess some characteristics like they are the recorded facts, they follow accounting principles and assumptions, and they also uh, are affected by the personal judgment of the accountants. Now, why financial statements are required? For the purpose of understandability, that is, it should be easily understandable to the users, and relevance. Financial statements must contain only the relevant information. Then only users can evaluate past, present, and the future events and can take wise decisions. They also should be reliable and accurate. That is, these statements should disclose information in such a way that users can compare the current year's progress with that of the previous year, and they also must be able to compare the financial performance of the reporting company with that of the other companies, and it also possesses the characteristics of comparability. That is, these statements should disclose information in such a way that the users can compare the current year's progress with that of the previous year, and the information should be complete in all respects. That is also one of the requirement of the financial statement, and this should be prepared, that is, the financial statement should be prepared within a reasonable time after the accounting period is over. So now I'll be discussing about the components of financial statements. That is, the financial statements can be prepared that is, we can prepare comparative statement analysis, and also that is the common size and the comparative income statements. We also can prepare common size balance sheets and the comparative balance sheets. We also can prepare the financial statement analysis through trend analysis, that is through making trend analysis, and also we can prepare the financial statement analysis by ratio analysis, that is by calculating the ratios, and also we can prepare the financial statements using cash flow statement as well as the fund flow statement. Actually, these are some of the types of financial statement analysis. So now, what is the what do you mean by analysis? What do you mean by interpretation? Uh, so the term analysis, it can be understood as the process of splitting the facts or data found in the financial statements into simple elements. Interpretation can be understood as the explanation of the meaning and significance of the financial data, so simplified with a view to throw light on profitability and financial position of an enterprise. Thus, analysis and interpretation of financial statements, it is the process of classifying the facts and figures given in the financial statements into simple understandable component or elements, and establishing the relationship between the elements, explaining the significance of the relationship between the classified component with a view to provide a full picture of the profitability and the financial position of an enterprise. So, coming to the definition of financial statement analysis, in the words of Myers, financial statement analysis is largely a study of relationship among the various financial factors in a business as disclosed by a single set of statements, and a study of the trend of these factors as shown in series of statements. And from the above definition, it is clear that it is an attempt to determine the meaning and the significance of the data found in the financial statements and derive meaningful understanding for making effective decisions. And the process of critical evaluation of financial information contained in the financial statements in order to understand and make decisions regarding the operations of the firm is called financial statement analysis. So basically it is a study of relationship among various financial facts and figures as given in a set of financial statements and the interpretation thereof to gain an insight into the profitability and operational efficiency of the firm to assess its financial health and future prospects. The term financial analysis includes both analysis and interpretation. Now, coming to the significance of financial analysis, which I'll be discussing in detail. Financial analysis, it is the process of identifying the financial strength and weakness of the firm by properly establishing relationships between the various items of the balance sheet and the statement of profit and loss. It can be undertaken by management of the firm or by parties outside the firm like owners, trade creditors, lenders, investors, labor unions, and etc. The nature of analysis will differ depending on the purpose of the analyst, and a technique frequently used by an analyst need not necessarily serve the purpose of other analysts because of the difference in the interests of the analysts. So, the financial analysis is useful and significant to different users in different ways. Like for financial manager, it is useful for the top management, for the trade payers, for the lenders, for the investors, for the labor unions and other parties. Financial analysis is required for different people. It is required for different purposes. And the objectives of financial analysis is to assess the current profitability and operational efficiency of the firm as a whole, as well as its different departments, so as to judge the financial health of the firm, to ascertain the relative importance of different components of the financial position of the firm, to identify the reasons for change in the profitability financial position of the firm, to judge the ability of the firm to repay its debt, and assessing the short term as well as long term liquidity position, to enable investors and creditors to evaluate past performance and financial position and to predict the future performance. And from where do we get the information for the purpose of financial analysis? So it would be individual investors, creditors, suppliers. They must often depend on published sources of information about the company, and the most common sources of information about the listed companies are the company annual reports, the stock exchanges, business periodicals, business television channels, and also the information services. So through this we can gather the information for the purpose of analysis by the various parties involved in the business organization. So, and when how do we compare? What are the standards of comparison in order to understand whether there is a consistency and performance between two companies, or whether there is consistency within an organization in different years? So these standards are creatures of experiences that are modified from time to time to meet changing conditions. They are an ideal or an average or normal results to be attained under certain conditions. Because of the changing nature of standards, constant acquaintance with the conditions under which they are set up is essential so that causes of variations from the standard can be intelligently appreciated. So for the purpose, comparisons are made with the following, like intra-company standards, that is companies will follow internal standards for monitoring and rewarding the performance, and competitors who are the rivals for the in the same business line. When people compete, they are trying to achieve the same goal and are therefore considered as competitors, and competitors' performance in the same industry sector can be compared to understand the performance of the firm. Then industry standards, the performance of company can be compared with that of other companies in the same industry. Comparison with industry standards will help to overcome the limitations of the historical comparison. Then also a rule of thumb indicator, that is there are guidelines, financial analysts and bankers use these guidelines for the purpose of comparison. For example, in case of current ratio, that is 2:1 is considered to be the ideal ratio, and this type of standards are those which become generally recognized as being desirable regardless of the company, its type, the time, stage of business cycles, or the objectives of the analyst. And also with respect to past performance of the company, financial analyst will compare company's current performance with its past performance. 5 or 10 year summaries of selected financial data will appear in some annual reports. Also, financial track record is cited in company prospectus and also the advertisements. A look at the past performance will show broadly whether the company is improving or declining. Even past ratios and percentages also will assist in extrapolating the results. So, coming to the types of financial statements, so financial statements are basically divided into two based on the basis of the mode of operation and on the basis of the material used. On the basis of mode of operation, it is classified into horizontal analysis and vertical analysis, and on the basis of materials used, it is classified into external analysis and internal analysis. So what is this horizontal analysis, which is classified on the basis of mode of operation? Financial analysis is done for number of years. It is known as horizontal analysis. Such an analysis set a trend wherein the figures of various years are compared with the base year. Decision based on the trend percentage, that is trend percentage and comparative financial statement is an example of horizontal analysis. And it is also known as dynamic analysis as it measures the change of position of the business over a number of years. Vertical analysis is analysis made for data covering 1 year's periods. It is known as vertical analysis. For example, ratios and common size financial statements are the example of vertical analysis. Now, what is external analysis and internal analysis? Financial statement analysis made by outsiders who have no access to the books of accounts. They are dependent on the published accounts. Example, shareholders, creditors, government agencies, etc. is called as external analysis, and internal analysis is financial statement analysis is made by internal parties who have access to the books of accounts like management, employees, etc. So now coming to the process of analysis and interpretation of financial statement, as I already told you, the term analysis is understood as the process of splitting the facts of or data found in the financial statements into simple elements, and interpretation can be understood as the explanation of the meaning and significance of financial data, so simplified with a view to throw light on the profitability and financial position of an enterprise. Thus, analysis and interpretation of financial statements is the process of classifying the facts and figures given in the financial statements into simple, understandable components or elements and establishing the relationship between the elements, explaining the significance of the relationship between the classified component with a view to provide a full picture of the profitability and the financial position of an enterprise. So now what are the tools and techniques of financial statement analysis? The most commonly used techniques of financial analysis are comparative statements, common size statements, trend analysis, ratio analysis, and cash flow statements. So now here in this week I will be explaining about the trend analysis and also the tools used, that is how to calculate the trend analysis. So what is trend analysis? Trend analysis, it is a technique of studying the operational results and financial position over a series of years. Using the previous year's data of a business enterprise, the trend percentage is the year. It is the percentage relationship which each item of different years bear to the same item in the base year. It is important because with its long run view, it may point to basic changes in the nature of the business. By looking at the trend in a particular ratio, one may find whether the ratio is falling, rising, or remaining relatively constant. From this observation, a problem is detected or the sign of good or poor management is detected. So I will be explaining you the problem, how to calculate the trend analysis. We will be solving problems on trend analysis. So here is an example. Sometimes it becomes necessary to know the trend changes in the financial position of the concern. When a concern needs to know the profitability trend of the organization, only profit and loss account independently may not serve the purpose. In such case, it is necessary to prepare a statement of the profit or loss or balance sheet for many years and taking any previous year as base, the trend or changes in the financial position can be prepared. When the financial statements of a number of years are analyzed, the analysis is called trend analysis. It is also called as horizontal analysis since it is prepared for many years, taking any previous year as the base year. In other words, horizontal analysis is a type of analysis in which there is comparison of the trend of each item in the financial statements over a number of years. In the horizontal analysis, the figures of the financial statements are analyzed horizontally. The trend of each item in the financial statements is compared over a number of years. The current year's figures are compared with the figures of the base year, or it is compared with the figures of the base year, and the changes in each of the elements or items from the base year is computed. Such changes are denoted in terms of percentage. It enables to find out the growth or decline percentage or the pattern of changes that are taking place in the organization. It enables managers to take necessary measures to curb the unhealthy trends in the organization. It is also useful to investors, bankers, and creditors to make effective financial decision on the company. It Trend analysis as a tool of decision making. It helps in many managerial decisions. It enables to find out the growth or decline percentage or the pattern of changes that are taking place in an organization. It enables managers to take necessary measures to curb the unhealthy trends in the organization. It is useful to investors, bankers, creditors to make effective financial decisions on the company, and its uses are: sales trends in the organization can reflect on the efficiency of the sales department. Sales trend enables management to take necessary steps wherever required to improve the overall operational efficiency. Trend on cost of operation facilities to take decisions on cost control and improving profitability. trend in the profitability reflects the overall efficiency of the organization in utilizing its resources and optimizing the return on investment. So students, I will be explaining you how to solve problem under trend analysis for taking a decision making, and here is a question. You could see here the information is given, that is the trend percentages of 5 years is given: 2011, 2012, 2013, 2014 and 2015 sales and closing stock, and also profit before tax is given. So how to calculate the trend? So when you look at the solution, so we have to take 2011 as the base year, and we have to compute sales, closing stock and profit before tax for other years. So how to solve this? How for 2011, it is 2,58,680. It is taken as the base, so hence it is 100%. Then for the next year, that is the year 2012, 3,53,460 is the sales. So how to calculate the trend of sales during the year 2012 is, we will divide 3,53,460 by 2,58,680 and multiply that by 100. We will get 137%. Similarly, we will do it for 2013, that is 3,68,550 divided by 2,58,680 into 100 gives you 142%. And during the year 2014, 4,12,430 divided by 2,58,680 into 100 gives you 159%. And during the year 2015, 4,88,560 divided by 2,58,680 into 100 gives you 188%. So when we look at from 2011 to 2015, there is an increase in sales. Year by year, the sales is been increasing. Similarly, we will do it for the closing stock, that is for the year 2011, 1,20,580, it is the base. So I'll be dividing 1,20,580 by 1,20,580 and multiply by 100. I will get 100%. So for next year, that is 2012, 1,25,760 divided by 1,20,580 into 100 gives you 104%. And 1,32,540 divided by 1,20,580 into 100 gives you 110% during the year 2013. So similarly, do it for 2014 and 15, we get 112% and 121%, and we could see the increase in the trend year by year of closing stock also. And profit before tax, so 2011 it is 55,750, and that I have taken as base. So 55,750 divided by 55,750 into 100 gives you 100%. And for 2012, 63,520 by 55,750, multiply that by 100 will give you 114%. Do it for 13, 14 and 15, and this also we can observe that there is an increase in trend. So this is how we will calculate the trend analysis, and we will interpret the results that, and we can say that compared to the base year from year 2012 to 2015, there is an increase in sales, there is increase in closing stock, and also increase in profit before tax. And we can interpret the change in increase, whether if we subtract 100 by 137, it is 37% during the year 2012. 142 minus 137, it is just 5% increase during 2013. And in 2014 there is an increase of 17%, and in 2015 there is an increase of 29%. So actually when we look at the increase in trend, it is not an it is there is, the consistency is not there in increase, but there is still increase in sales. So there would be various reasons why there would not be consistency, but there is an increase in trend of sales, and also there is an increase in profit. The profit increases during 2012, it is 114, during 13 it is just 3%, and during 2014 it is 130 minus 117, it is 13%, and during 2015 it is 27%. So this is how we are going to interpret the results of the trend analysis. There is another question where we can find out the trend analysis. So here sales is given, cost of goods is given, gross profit is given, operating expenses, operating profit, and taxes and profit after tax is given. So from this, and for how many years it is given? It is given for 4 years. We can keep 2007 as the base year, and we can calculate sales, gross profit, operating profit, and profit after tax for 2008, 2009 and 2010, as we did it for the previous question. That is 2007 is kept as base, so it is 100. 90 divided by 100 into 100 will give 90%. That is during 2008 it is 90%, during 2009 120 by 90 into 100 it is 120%, and during 2010 it is 150 by 100 into 100 it is 150%. And the change, when we look at the change, there is decrease in sales during the year 2008, but during year 2009 and 10 it is increase, that is 20% increase during the year 2009 and 50% increase during the year 2010. And hence the gross profit, there is a loss, it is not profit, it is loss during the year 2008. The loss is 25%, and during 2009 and 10 there is a profit of 25% and 75%. Even operating profit, there is loss of 33% during the year 2008, and during the year 2009 and 10 there is an increase of 17% and 67%, and profit after tax there is a loss of 33%, and this loss is due to the reduction in sales during the year 2008. That is how we are going to interpret the results of the trend analysis. So thank you. I will be explaining you in detail in our regular classes.